The pro forma is really good for just evaluating deals and kind of wrapping your head around a deal. But ultimately, when you make a decision to buy a property, you've got to have a really good handle on, are those assumptions that you made accurate?
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 378. My guest today has a quantitative and repeatable process for identifying areas that will experience 20 to 30% appreciation over a 5-year period. Not only does Mark Updegraff have a background in science, technology, and mathematics, he also began his career at NASA. So I'm excited to see how that background has translated to his real estate development, management, and brokerage businesses. Mark, welcome to the show.
Thank you so much. It's great to be here.
I don't know that I know anyone who's ever worked at NASA. So kind of take us from that, what you were doing, to this new world of real estate, which I know is not new to you anymore, but it is quite a transition.
It was a huge transition. In the sciences, I was very involved in math. It was kind of my jam, if you will. I was really good at it. And, matrix algebra was my favorite class going through graduate studies. So I was a huge math geek. And when I got over to the real estate side, the math was just so simple. It was kind of disheartening because I was like, oh no, I'm going to be stuck doing this with all this really simple elementary math. So that was kind of my reason for trying to dive as deep as I can into the mathematics behind real estate. And, I'm always working on it in the background with different hypotheses and trying to do a little bit more advanced research, but the data sets are so wide and they come from so many different sources and they need to be aggregated in so many different ways that sometimes it's tough to hunker down and to figure out what problem you're trying to solve with inside that data set, especially because we know real estate is so hyper locational. So getting those data sets that are relevant to the hypothesis that you're trying to prove is pretty important. So I've seen some success, but really it all started just using common sense more so than math. So when I got started in the business as a broker, I would help a lot of people, as a new person in the Rochester market, not coming from Rochester, I didn't have a huge sphere of influence. So I was really limited in who I could work with. I couldn't, tap into my network of people that I grew up with. So I really had to be a marketer and I had to go out and get those leads myself. Most of the leads that were coming to me were first-time homebuyers, the majority of them, I would tell you. And they were all shopping in different price points. At first, the leads that were coming in were pretty much shopping in an entry-level product. And so when you have this demographic of people that are trying to get into a house, they're trying to get into their first house, and they've got limited means, there's very few places that they can go to shop for that house. Because if you put them in a very competitive marketplace, they just can't compete. Even when the market's not as competitive, if you've got an FHA buyer versus a conventional buyer, chances are the seller's going to go with the conventional buyer just because it's a safer bet as far as the likelihood of it closing. Even if, your FHA buyer is super solid, they'll still end up losing the deal. So what I was seeing happen was that, these people wanted to get into a nice spot to raise their family, good schools, et cetera. And they would get frustrated in that, they would lose and they would lose and they would lose. And eventually we'd have to pivot out of, the market of their choice, and we'd have to find the next best market for them. And we would do a lot of research going into it to figure out, how things were transitioning and just kind of, driving the streets and feeling it out to make sure that they felt comfortable living there. And then I started overlaying some metrics over the years to kind of quantify, first with just a real quick litmus test, which they call a gross rent multiplier. It's a quick way just to see, how the cash flow of an asset stacks up. And I could use that against historical numbers and kind of build my database of trends in the area. So I could keep an eye on this gross rent multiplier, and I could keep them separated into segments. So I think a lot of real estate is localized based on delineators for some psychological reason. If you've got a river or if you've got a bridge or if you've got a major arterial road, they can all kind of form barriers where values on one side of the barrier are going to be different than values on the other side. And in some situations, you can see pretty significant differences between one side of the barrier and the other. So I kind of started by color coding the map, going in and breaking it up into different sections, different shapes, and then overlaying a gross rent multiplier on top of those shapes to kind of look at how all the interactions were working together. And it was pretty easy to figure out that, if you've got a really nice area with a high gross rent multiplier bordering another area with a low gross rent multiplier, that there's a good probability that some of that will spill over and it'll start to change the demographics inside of that lower gross rent multiplier. So the first time that I witnessed it, it was a real low gross rent multiplier, and it was completely surrounded by pretty high, strong gross rent multiplier numbers. So I would tell you that this market was probably between like a 4 and a 6 gross rent multiplier, and it was surrounded by like an 8 gross rent multiplier. If you know anything about gross rent multiplier and you're a cash flow investor, once the gross rent multiplier gets a little too high, it's really you're parking wealth and you're not really getting any cash flow. The tipping points, if you're putting leverage on it, is going to be dependent on what you're paying for your finance. But, in today's market, we would say that you've probably got to be down around like a 5 or a 6 to really eke out any cash flow. Rewind 5-10 years ago, and you could probably purchase around an 8 gross rent multiplier and still be cash flow neutral.
Gross rent multiplier. This is a ratio that I don't really use in my own business, but just so people who are listening can track this and understand what you're talking about, how do you calculate gross rent multiplier?
The gross rent multiplier is just your asset value divided by your gross yearly rent.
So give us an example.
So if you've got something that's throwing off a lot of cash, it's going to have a low gross rent multiplier, right? So if it's a $100,000 house and it's bringing in $25,000 gross per year, you've got a 4 gross rent multiplier. So it's throwing off $10,000, then it would be a 10 gross rent multiplier, right? Because 10,000 goes into 110 times.
What are we tracking there? So if it's a higher gross rent multiplier, then what does that mean versus a lower gross rent multiplier?
So I use the gross rent multiplier as a real quick litmus test before I jump into a full-fledged pro forma. So that's going to give me that quick analysis to see if the asset's in line with the historic market before I really get into the nitty-gritty of the taxes and the insurance and all that. So this is just meant as a real quick test to see if the opportunity that you're looking at is even worth digging into any further. And so, using the gross rent multiplier, I know that on average, if an area is trading around a 4 gross rent multiplier, that it's a really good cash flowing market. It's a market that I can go into. And, if I'm exploring opportunities, I'm expecting that the gross rent multiplier is going to come in somewhere around that average. Now, if it's below the average, that's great, because that means I'm getting even more cash flow in an area where the average is higher. So I could get a pretty good spike on appreciation and just off, instant equity when you buy, if you will. So again, this is all the preliminary numbers that we use before we get into the pro forma. And then we can talk about that a little bit as we get to it.
What I think I heard you say was that by looking at the gross rent multiplier overlay of the areas that your frustrated buyers were looking in, you were able to identify like path of progress neighborhoods, fringe neighborhoods that were on the edge of the desirable neighborhoods, but maybe weren't as competitive and easier to get your buyers into.
That's absolutely correct. Yep. So, they're looking for my guidance as the real estate experts. Some of them might be moving into town and not really familiar with town. So I really go to bat for my buyers. And a lot of times I do extra work, I have over the years to make sure I'm getting them into the correct property that's going to really provide for their family and give them a good leg up, as far as, buying something with a little bit of equity or buying something that's a value add in an area that they couldn't get in otherwise. So I've got just tons and tons of stories about people that I've helped over the years do that exact thing. It's the same thing that we do as investors. We're always looking for an opportunity where we can get something that's below market value, or when we add a little bit of value, we're really going to increase the final value, the after repair value. So it's the same concept, and using that GRM and just looking at the math and building the map, it made it easy for me to identify areas that were isolatable and then also in a good position for as things, developed and the gross rent multipliers in these really popular areas went through the roof, that they would be in a position to kind of follow that trend. The other metric that I use in conjunction with the GRM at the beginning of the analysis before we dig into a pro forma is just price per foot. And so, price per foot is going to change over time. It's tied to inflation, it's tied to a lot of different things, but we know what a full retail trade looks like, and it's real easy to calculate. So using the access that I have as a broker, I can get into all of New York State's data set, and I can export whatever I want in whatever format I want and get whatever, different parameters that I want out of it. And so I've built a system where I can easily get in there. I can pick the different properties that I want, either, using the map or using different criteria. I can export them and I can calculate a price per foot. So that goes into what I do as kind of like a next step. And knowing that, okay, if a full retail trade is, it's going to depend on which market you're in, but let's just say, $150 per foot is a full retail trade for that particular neighborhood. And, we're looking at an area where the trades are averaging at like $80 to $90 a foot. And we know that it's on the area of a higher GRM where we're seeing those final trades in the 130 to 160 range, pretty much maximum price per foot as far as retail goes, that there's going to be some spillover when the market is such that you have people that can't get into the market. So they've got to go somewhere else. They end up going to the next best place, which, if you're good at your craft, you can get them into an area like this that's on the border of something that's increasing pretty rapidly just because of supply and demand constraints, the popularity, the buzz. And I've found that the buzz does change over time, and it's going to be contingent on different businesses that are establishing themselves and gaining popularity. But it all kind of revolves around that younger demographic that's looking for their first house. So that's kind of why I started doing it, because they were also the ones that were tending to be FHA and they were having difficulty getting in. So we've always been looking to position them in an area where we could get them close to where they wanted to be, but also not close in the direction where things were really kind of falling off quickly and going to those low gross rent multipliers where you tend to have issues with deferred maintenance and with crime and stuff like that.
Your ability to identify areas where you're going to experience 20 to 30% appreciation in a 3 to 5 year period, is that specifically tied to your overview of the gross rent multiplier and price per square foot and identifying those path of progress neighborhoods? Or is there more to it?
I mean, I'll get into the pro formas of things just to kind of make sure, because the first two metrics that we're using are kind of broad, right? So you want to refine what you know about a neighborhood a little bit more than just making these more generalized assumptions based on a metric like gross rent multiplier. For instance, some rents might include heat and other rents might not include heat. Some areas might have higher taxes because the assessed values have gone up more relative to other areas. So there's a lot of parameters that go into it. So I use those first two metrics as kind of my jumping off point, to craft my different theses as far as where we're going to put our delineators. But then I'll dive in on specific examples and really look at pro forma analysis of assets across the board from single family to multifamily and commercial, just to make sure I have a good handle on what the actual cash on cash returns are looking like in those neighborhoods, and then tracking those trends as well. The data set is going to be a little bit smaller because it's a little bit more laborious to do all of that. But I still have that as like a final overlay where I'm looking to make sure that, my assumptions from the broader metrics are actually correct.
The data sets that you get, how do you find those? Are those available to anyone? Like if anyone wanted to do their own overlay of GRM, gross rent multiplier, and price per square foot, do they have to subscribe to a service, or can they just go on Zillow and figure this out themselves?
GRM is going to be kind of your knowledge base more than a data set, right? So you're going to have to know what the rents are pretty well. Luckily I've got a management company, so I've got a good handle on what the rents are going to be, you can certainly go to a site like Rentometer and just maybe be a little conservative if you're not sure if what they're telling you is correct. You could check listing rates on Zillow as far as rental rates and get a pretty good, accurate representation of what those are looking like. But ultimately, I would be conservative if I didn't know what the numbers were for rent specifically. So that's where you get the rent number, and then the asset price. You can just assume that it's a full value trade. If you're doing this and you don't have access to the data set. I use my access as a broker to be able to get in there and pull out comps. So when I'm going into a pro forma analysis, I can have real numbers, the actual trades, and then I'll use my property management team to give me the rents that they could achieve in that market based on, timing and all that. That's more so as we get into specific properties and maybe we're working with an investor that really wants to know what his cash on cash is going to be. But as far as identifying those areas, I think the GRMs are a good way to break up the market and then just double check it with a few actual pro forma analysis inside of those markets to make sure that your assumptions are correct.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Having your NASA level mathematics and science background, I'm sure that's extremely helpful when you're analyzing data sets. But I can also imagine it's both a blessing and a curse because there are probably decisions that you have to make where you have to go outside the math. How do you deal with that?
Yeah, I call it the little old lady house. So once we've done all of the due diligence on the front end, we've checked our GRM, it looks good. We've dug into our pro forma, we've calculated an exact cash on cash. If somebody's going to use finance, we've taken it one step further and we've done the pro forma on a finance level to see what their return is going to be with that finance. Once we've done all that and the property looks good, we get into the field and I'm looking for what I refer to as the little old lady house. They tend to be properties that have been in the same family for a number of years. Maybe one person's owned it for decades. Sometimes it's been passed down within the family for a few decades. But regardless, it's had less turnover inside of the house. Maybe one family was raised in it over 50 years versus 5 families or 6 families. And you can imagine that, all the kids growing up in a house have a little bit of wear and tear. And then every time somebody moves in or out of a house, you're going to have some wear and tear on the house as far as a little bit of beat up moldings from furniture coming in and out, and then people that want to make their mark on the house and change some stuff. And, a lot of DIY type stuff happens when you have different sets of owners coming in. And so I really like the properties that have not traded as many times. They tend to have people in them that have focused on the CapEx. They've done the roof, they've done the mechanics, they've done the windows. They probably still have shag carpeting. They probably still have a kitchen from 1960 or 1970, but these are all real easy things. And in my market, when you peel back the shag carpet, you're often left with gorgeous hardwood floors that haven't been, that haven't really seen the light of day since the 1960s. So they're real easy to refurbish. And, we've got kitchens and bathrooms to a science. We know what it's going to cost. So we just budget that into our pro forma. When we acquire an asset like that, so we just add that straight to the top. So if we were doing a calculation, we could do that as part of our basis.
that's your brokerage business, but you're also doing commercial multifamily and other things. I love the fact that we're focusing on math here, because I think the better you understand math in investing in real estate, the more money you can make. When you get to commercial multifamily and some of the other commercial type investments you've been doing, how does the math factor into that as well?
Sometimes it can be a lot easier. If you can get a triple net lease, you can take a lot of the risk out of some of the other investments that we were just talking about, where, you're paying the taxes. And if the taxes go up, your rent might not be able to go up as much to accommodate the increase in taxes, especially in the environment that we're in today, where we're seeing markets that are exploding in value. So I have a lot of properties that I've purchased over the years at very good discount rates. And then those neighborhoods have doubled, tripled in value. So, as my taxes go up, I'm going to have my tenant absorb those taxes. Otherwise, my ROI is going to go down. When you're working in the commercial world, most of the time you're dealing with a triple net lease, and you're pretty much hands off on the expenditure changes on the building side, because your tenant is going to take care of those. He's going to absorb those increases. The only risky part about a commercial deal is that, you tend to have a higher vacancy rate in order to place that good anchor tenant. So, it might not be for everybody right away. They might want to start with something where you can have a little bit less of a vacancy rate. I think commercial is good for experienced investors who understand that they might have to weather a little bit of vacancy in the beginning of owning the asset or in between tenants, but they know they're going to get a really good tenant that's going to come in, and they're going to be there, with a 5-year triple net lease with a couple options with good bumps in those leases. So they know they're protected over time. And, worst case scenario, they're looking for a tenant in 5 years instead of in 1 year. So the math on the commercial side, it's very similar to, what I do on the single and multifamily side. It's just, there's different things about some of the leases as far as that goes, but otherwise it's very similar.
When you say triple net lease, that's when you have a single tenant, like a retail tenant or maybe an industrial tenant in a building, and they're going to be in there for a long time, and they're paying all the expenses. But you also invest in multifamily, right?
Mm-hmm.
Which is commercial. So how do you look at the numbers when it comes to multifamily?
I keep my underwriting very conservatively. I know a lot of people will reduce what they're using for their reserves. And, that's going to be a decision that you have to make when you're getting close to a buy decision. So your value is going to really come down to location. And the nicer location that you want to buy in, the worse your return is going to look. But the reality is, you're going to own it, and you're going to file your taxes at the end of the year, and you're going to see how it's performing. So a lot of people will start to chase cash flow, and they'll go to those low GRM areas, and then they'll experience higher vacancies. They'll experience more deferred maintenance issues, evictions and stuff like that, which really impacts their return on investment. So the back of the envelope starts to break down and fall apart. When you get into multifamily, economies of scale, you still have similar issues, right? Depending on what type of neighborhood you're in. And I think people that are inexperienced in operating multifamily might not realize how big of a problem you could have if you go into an asset in an area that's tough to manage, that's surrounded by other deferred properties that, have drug use and have crime. It might look really great on paper, but then the reality of owning it, and you file your tax returns and you're just like, oh my goodness, what did I get myself into? This is not doing what I thought it was going to do. So the pro forma is really good for just evaluating deals and kind of wrapping your head around a deal. But ultimately, when you make a decision to buy a property, you've got to have a really good handle on, are those assumptions that you made accurate? Right. And the assumptions are going to change based on what class you're purchasing in. So if you're purchasing in a C versus an A, I can tell you firsthand that the assumptions are not the same. So if you have the same pro forma looking at both, you're going to be too conservative on the A, and you're not going to be conservative enough on the C. So, the pro forma is great. It's great to get you in there and it gets you started. But ultimately, you're going to have to plant your flag somewhere. I recommend that people kind of, if they're not sure what they want to do, I would stray closer to the A side if you can. I would sacrifice some of that cash flow, to get an asset in a better area, see how it performs. And then if you can stomach going a little bit to the other side, go ahead and try that. see how that performs. And then you can kind of build your portfolio based on how your assets are performing. And you'll know that, okay, if I purchase this type of asset in this type of area, this is about what I'm going to expect. So over time, I started in the middle, and we've and bobbed on both sides of the line as far as cash flow and as far as, nicer area. And I've gravitated towards the nicer areas, especially the longer that I've been doing this. There's less headaches. There's more opportunity for appreciation. You've got more opportunity for rent growth, for stability as far as, how much rent you're collecting, how much bad debt you have. So I just think that you got to be real careful if you're just getting into multifamily, large multifamily, that you don't steer too far onto the, C or D class that, it looks really great on paper, but the reality is it's not going to be able to perform like that.
What would you say to our listeners about just the importance of understanding the math when it comes to real estate investing, and tips on how they might come to understand the math even better?
So the math is super simple, but everybody's going to have certain assumptions that they put into it. So when somebody brings me an opportunity that, they've underwritten themselves, and, they probably have a fancy spreadsheet or they've used an online calculator, I just don't even look at that. I take everything back to the very, very basics, and I like to keep things simple. And I like to use the same pro forma every single time I analyze a deal, just so I know how it compares. So if I always use the same pro forma, then I can say, okay, my historic knowledge of using this same exact pro forma for the last 15 years, I can see if it's a good opportunity. Now, like I said before, it's not my end all be all. It's kind of like a quick check. And then you really need to know, what assumptions are the seller making or trying to sell you on. If you're listening to the marketing material of a seller, they're going to have less conservative underwriting because they want to prop up their cap rate. So, you need to get comfortable with what are you willing to put down for those assumptions? What are you assuming for vacancy? What are you assuming for property management? What are you assuming for repair? A lot of those numbers you can drill in and get, and you can interview people. But I think the age-old saying, you get what you pay for, is really true. So you might have one management company that offers to manage your unit for a huge discount. Just know that you're going to get a discount in the services that they're able to provide you, because they don't have the capacity, they don't have the financial capacity to offer any more services. They're giving you that service at a discount. And as such, you're getting a discounted service. So shop around, know what people offer specifically for how much they charge. And the repairs, I think that's, industry standard. You could throw in a 5% repair budget. Vacancy factor, that's going to depend on what class asset that you're in. That's one that, I usually underwrite with a 10% factor. And then, depending on the asset's location and the tenant base, I may be willing to change that. And then also based on, the assets that I own and how they perform. But when I underwrite things, I want to under promise, over deliver, right? So I'm going to always underwrite conservatively. I want it to hit those numbers, but I'll still make a buy decision, even if the numbers look a little tight, because I know that my underwriting is so conservative that I've got a little bit of wiggle room where I can make a buy decision if I really like the location, or it's got a good strategic opportunity to maybe add some value or be in the path of progress. So, your numbers are just they're just kind of a starting off place, and you really need to own something to really see how your assumptions play. And then once you've done that, your experience and your track record will give you a good feel to kind of wade through the BS and not listen to the marketing materials that are coming at you, being able to make your own underwriting and have confidence that the underwriting that you've done is going to perform better than how you underwrote it, and be able to move forward and just keep having those benchmarks that you look back on year after year to say, okay, this one's performing really well. Why is this one performing better than that one? And then you can start to figure out, okay, well, it wasn't quite as deferred. The tenant base was better. It was close to this really great employer. And you can start to, craft your search criteria based on your comfort level with risk and how you operate, how your manager operates, et cetera.
Do you have any suggestions for underwriting software, analysis software that people might be able to access?
I just keep everything very, very simple. So I'd be happy to share that with you guys. I don't even use a spreadsheet. I just do everything right in a little text document. I do it per property, and then I can archive that and keep it for later. So I'll date it and I'll know where it is on the map so I can look back at my historics. But I just have a small little snippet in my notes file.
What's your favorite hack or app?
Every day I use my broker tools. So luckily, I'm licensed. I can get in there and I can get into that data set. For somebody that doesn't have that availability, you could always ping your realtor and try to get that. But if you're going to be serious about investing in real estate, it might be worth your while to pay that fee, not to be a broker or to be an agent, but just to have access to the data set. It is nice being able to go in there and, you could use it for prospecting. You can use it for analysis. So I really love having that access. I use it multiple times a day. I'm always in there. So I'd say for me, that's my biggest use as far as data and as far as being able to export stuff into spreadsheets where I can look at neighborhoods and I can look at streets and I can look at, counties, or I can look at cities. So that's been really, really powerful. I don't know how you would get that without having that kind of access.
And how would people find out more about you or get a hold of you?
So my website is raisecapital.com. It's RAZE capital.com.
Mark, thanks for coming on the show and sharing your techniques with us. I'm really interested in the math that you're using. You did an excellent job explaining gross rent multiplier, which is a ratio that we really haven't talked about on this show, and I think is very valuable to our listeners. Thank you for having this conversation. It's been a real pleasure.
Pleasure's all mine. Thank you so much.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.